Alright, so we have our example set up. We're going to create a simple accounting system to keep track of the bucket of money that you and your sibling have put in front of the door. Now, here's our accounting system. We're going to have what we call stuff and claims to stuff. Stuff is obviously what we own. In the example we're using, the only thing we have is cash. So I've got the little cash bucket drawn here. And the only two people that have a claim to what's in that bucket, you and your sibling. Okay, so my claim and the sibling claim is right there. Now, in our accounting system, in the simple one we're talking about today, and the ones that we kind of evolve into later on, we always have to be in balance. And what I mean by that is one side always has to equal the other. So in this case, our stuff always has to equal claims to stuff. What we have always has to equal who's the owner of it. Okay, it's always, whether we're talking about a simple thing like our example here, or a full-blown accounting system like Walmart would have in place. So let's go ahead and look at a couple transactions, and keeping in mind that every transaction that we make with the bucket has to keep our little equation in balance here, the stuff equals claims to stuff. So let's just assume, for argument's sake, that you come along and you put $35 into the bucket. Now, before, we just had an empty bucket sitting by the door. So before, there was nothing in that bucket. The beginning balance was 0. There was no claim because there was nothing in it. So nobody really had any claim to what was in the bucket because there was nothing in the bucket. But you come along and you drop $35 into the bucket. So I'm going to put 35 there, and we're going to just kind of draw maybe a 20, a 10, and a 5 in our bucket here to represent $35. So here's our 20, here's our 10, and here's our 5. So $35 in cash, you throw that in the bucket, and now we have $35 worth of stuff. And you are the person that has a claim to that $35. So in our accounting system, notice that we made an entry on the left side, and we made an entry on the right side. We have $35 worth of stuff, and in this case cash, and the owners have a $35 claim to that stuff. $35 here, and of that $35 you have a claim to every bit of it. Okay? But I'll say that your sibling comes along and they want to put in 15. So they'll drop 15 into the bucket. We'll just kind of draw a 10 and a 5 here to represent that 15. And we'll make sure we put 15 there to keep track of our cash. That claim doesn't belong to you. Your sibling put it in, so we're going to account for that under this little account here that says sibling claims. Now we actually have $50 worth of stuff. So we need to update our equation up here. I'm just going to take an eraser and mark that off. And we're going to update $50 worth of stuff. We put 35 in the bucket. Sibling put 35 in the bucket. So notice by making a little entry on both sides, I'm able to keep everything in balance. That's like the first commandment in accounting is thou shalt always be in balance. If you're not in balance, then everything is boogered up and you've done something wrong. So the whole point of the bucket was to kind of keep some money sitting around so we could go out and have fun, right? So we're not just going to throw money into the bucket all the time. We're going to take some money out and go have some fun too. So your sibling comes along and says, you know what, I'm going to go out and I want to take $5 and go hit the town. I don't know how far $5 on the town is going to get you. Maybe you can go to Little Caesars and get a hot and ready pizza, something like that. It's not going to get you too far, but in any event, she's going to take out this $5 right here, and it's going to go out of the bucket. So we need to take $5 out of our cash here, and since the sibling took $5 out of the bucket, her claim to the money in the bucket goes down by $5. When they took that money out, they no longer had a claim to it because they took it with them. So let's update our equation. We have 50. Sibling comes along and takes out 5. That means we only have $45 left in the bucket. Of that $45 amount, your claim is still $35 because you didn't take anything out, and the sibling claim is now $10 because they took out $5. So notice again, we still balance $45 in the bucket, and the claim to that $45 is divided up. $35 belongs to you, and $10 belongs to the sibling because they took out $5. Let's assume that you come along and you want to have a little bit more fun, so you take out $10. You can't quite do your night on the town for $5. You come along, you take out $10. So goodbye $10. It's coming out of the bucket, and your claim is going to go down by $10. Okay. So we had 50. Sibling took out 5. You just took out 10. So now we're down to $35 in our bucket. Every time a transaction is made, our little equation stays in balance. That's important to remember. I keep saying it, but it's an important concept. So we'll beat it into the ground. $35 in cash. Of that 35, I have a claim to 25, and the sibling has a claim to 10. Okay? So let's say, for the sake of argument, that your pops comes along and he sees the bucket of money and asks about it, and you explain to him that you and your sibling have kind of pulled your money together so you can go out and party, and the old man is so impressed with what you're doing that he says, you know what, I want to contribute some money to the bucket. I'm not going to give it to you. I'm going to loan it to you. So Pops is going to be a creditor in the whole deal here. He's not going to have an ownership stake in that bucket. He's just going to give you some money with the expectation that you'll pay him back. So Pops is going to loan you $20 to the money bucket here. He's going to throw in 20. So we'll put a $20 bill down here. So we're going to add $20. Now, where we're going to put that on the claims to stuff side, if you look, we have a place to put my claim, we have a place to put the sibling claim, but we don't really have anything else. Let's go ahead and make a new account, and we'll kind of draw a little box here, and we'll just put dad claim. Okay. He started with 0, and then he put in 20. Let's take a step back and recalculate everything and make sure we're in balance here. I'll put the $20 that Dad loaned the bucket in the cash bucket, and then I put it over here under an account for his claim. So we need to do some retabulating, make sure we're still in balance here. 35, 50, we took out 5, that takes us to 45, we took out 10 more, takes us to 35, and now we've added 20 from Dad's loan. So if my math is right, that puts us at $55 worth of stuff. We come over here, Dad's claim was 20. Our claim was 25. That's 45. Sibling's claim is 10. That gives me $55 altogether. So we're still in balance. Stuff, $55 worth of cash equals claims to stuff. My claim is 25, siblings is 10, and Dad's is 20. Now there's an important distinction to make here, and I want to make it clear. These two accounts here, my claim and the sibling claim, we're owners of the bucket. These are ownership claims. Dad isn't an owner. He's a loaner. He's a creditor. He wants that money back. Okay? So that'll become important later on. Just kind of keep in the back of your mind in our simple setup right here. My claim and siblings, we're the owner of that bucket. That bucket belongs to us. Dad is a creditor. So while he has a claim to the money in the bucket to the tune of $20, his claim is more of a creditor. He's kind of entitled to get that $20 back, probably plus interest if it's anything like my dad. But we'll kind of build from there in the next video. We'll talk about how to arrange all this information in what we call a balance sheet. And then we'll start to add a few accounting terms along to it.